Hey guys, welcome to chapter one. So you've already seen the video about the intro to the study material. You've already seen the video about mastering the exam. We're going to start to break down chapter one for you. And guys, of course, like I said from the very beginning, make sure that you read all of these different sections 2 times minimum. That way you get a good understanding for it. You kind of develop this foundation in your mind for the information, the different concepts. But the bulk of the information that you really need to know is going to be in this chapter recap. So to save yourself the time of a very long video of listening to me talk, I'm just going to go over the chapter recap, hit on all the main points that you're going to need to know for this chapter. Again, this is chapter one, which is going to be completing the exam, underwriting, completing the application, underwriting, and delivering the policy. So the general concepts that you need to know is the general concept of insurance. What is insurance? It's where you transfer the risk of loss from an individual to an insurer based on the principle of indemnity and based on spreading the risk pooling in law of large numbers. That's mostly based for the risk that the life insurance company takes. They're going to say, hey, you're going to pay us our premium. We're going to hope that not everybody, every single person that we're serving and that we have life insurance contracts with dies in 1 year. We hope to spread out the risk, law of large numbers, where we can take enough money from premiums and pay out death benefits whenever they arise. So that's the idea of, the insurance company spreading their risk pooling, and then the law of large numbers. Insurable interest. You must have insurable interest that exists at the time of application. So what that means is you have to have an interest to the person that you're insuring. So if it's my children, obviously there's an insurable interest there. You can't just go meet some guy down the street and be like, hey, I want to get a life insurance policy on you. They're like, the insurance company's like, where does that come from? Where's the connection? Where's the insurable interest there? You'll see a lot of this time in family members when people take life insurance policies out on their family members. Typically, it's immediate family, mothers, fathers, spouses, children, business owners. Once we get into key man and everything like that for the business owners, and as you can see, you're going to insure your own life, a family member, or business partner. So there has to be insurable interest at the application. Let's say you're married to somebody or your spouse, at that time, and you have a life insurance policy on them. A few years go down the road, it doesn't work out. That's now your ex-spouse. It doesn't matter. They'll still pay you that death benefit if you have that life insurance policy on them because you had insurable interest at the time of application. That's when it matters. So make sure that you know insurable interest at the time of application. Insurance contracts. What are the elements of a legal contract? There's 4 main things that you have to consider. An agreement, an offer, and an acceptance. We are putting forth as whenever we represent a client or we're insuring ourselves as an individual, we are putting an offer out to that insurance company and they have to accept it. They say, okay, yes, you have good health, your financials are good, and you accept the premium payments that we're willing to offer. They have to accept our offer to get the acceptance. So offer comes from the individual or the insured or proposed insured. Acceptance comes from the insurer. So very important to understand. That's rule number 1 when it comes to elements of a legal contract. 2, consideration. Think of consideration as what a lot of people want to think it is an exchange, right? So if I give you consideration, that means that I'm giving you something, you're giving me something. So we are giving the insurance company premiums and representations as part of the insured. The individual, the insured, is giving a premium, and in payment of return, we're getting the death benefit or the claims under the insured. So consideration goes both ways. And that is a bilateral contract. You'll look into that whenever you actually read through the chapter. So you got to understand that. Consideration is I'm giving the insurance company premiums, they're giving me the death benefit when we die. Competent parties. You have to be a legal age, not a minor. So that's very important to understand. You cannot be a minor. That doesn't work. You have to have sound mental capacity, and you cannot be under the influence of drugs or alcohol. On the test, it's going to say if they're under mind impairing medication, or they're going to try to trick you and say a 17-year-old wants to get into this illegal contract. It's not legal. So make sure that you understand competent parties are people who are above the legal age, not a minor, have sound mental capacity. They don't have, dementia. They don't have some kind of mental disability that keeps them from, going into a legal contract, and that they're not under the influence. So very important. And then legal purpose. Obviously, guys, you can't be, come into a legal contract if it's about something that's an illegal activity, right? So legal purpose is kind of the obvious one. You can't go say, hey, I'm going to get into a legal contract where I'm going to commit a crime, right? So, use some sense there, but know the four main points of a legal contract. You're going to see a lot of times during this exam: agreement, consideration, competent parties, and legal purpose. Those are the four main pillars for a legal contract. So, contract characteristics. Adhesion. I always think of this one as like glue. Think of adhesion, adhesive, glue. So one party prepares a contract, the other party must accept it as it is. And that's kind of what you get from a life insurance contract. It is kind of bilateral because there's two, agreeing consideration parts. But more than anything, it's kind of an adhesive situation where, hey, we're going to say that we're going to give you, $100,000 death benefit for this premium payment of $50 a month term, or whatever it may be. So once they prepare the contract, the other party has to accept it as is. Think of adhesion glue, you're stuck with it. So I'm stuck with whatever contract they give me. Aleatory, exchange of unequal amounts. This is saying, hey, I'm going to give you $10, you're going to give me $100. It's not really a fair trade. So understand that aleatory is an exchange of unequal amounts. The best way that you can maybe think about this in life insurance is if you pay two premium payments for a ginormous death benefit, and then the insurance company has to pay that out. That's not a very good, that's an aleatory contract. It's not really equal as far as the consideration that has been given. But that would be, a good situation if something were to happen and you still were not out a lot of money. That's besides the point. Conditional. This is where a lot of people get conditional and consideration confused. Conditional means that certain conditions have to be met. You have to make your premium payments on time. You have to make sure that your health and everything that you stated is accurate, and you have to make sure that you hold up your end of the bargain so that they can hold up their end of the bargain. If you don't pay premium payments, guys, and you let that policy expire, you're not getting a death benefit for yourself, your clients, whoever it may be, the people that you're serving. Unilateral, I always think of this as like unicorn, unibrow, whatever it is. Uni equals one. Only one of the parties to the contract is legally bound to do anything. So if there's a contract where somebody has to do something and it's only one party has to provide consideration, just know that that is a unilateral contract. Process of issuing a life insurance policy. So field underwriting is done by the agent. That's done by you. You guys do the application, you get it completed, you get it signed, you get the agent report, which is basically your observations about the applicant that can really assist in the underwriting process. And then you get the premiums with the application or conditional receipts. So you are the main point of contact. You're in the field, you're gathering the information. Hey, they're in good health, or maybe they have diabetes or some kind of health condition or COPD, whatever it may be. They're going to really base a lot of that information based off of what you say in that initial application or your agent report, where you put a little bit more, in the detailed notes, like, hey, they kind of were quiet on one part of the exam or through the application process rather. And then premiums with application and conditional receipts. Do you take the premium with the application so they can get day one coverage? Do you do the conditional receipt saying, hey, that you're going to be taken care of as long as everything you put on the application is correct and accurate? So we send that in, and the company does their own underwriting. They're going to have multiple sources of information. Number one is going to be the application, what you put, like we said, and then the consumer reports based off your financials, everything that pops up from different types of crediting sources, and then your MIB, which is Medical Information Bureau. And what they're going to do is they're going to pull up the MIB report, and it's going to have all your doctor's visits, everything there. So if you say, hey, this person hasn't had a surgery in 5 years, and the MIB is going to pop up and be like, dude, they had like open heart surgery like a year ago. That's going to pop up. So make sure that you get accurate information on the application, because at the end of the day, they're going to look at that MIB report, the company is, and that's going to really determine if they're going to take on that risk or take on that client. You're going to have typically 3 different types of risk classifications. Each insurance company is different, but you're going to have standard, which is just, average health, maybe a little heavy, maybe has a little bit of health issues, but they're not really worried about it. So you're going to standard. Preferred is better, great health, all good, really going to have a lot better premium that way. And then you're going to have substandard. Substandard is going to be higher premiums because they have really bad health. It's more of a risk for the insurance company. So understand that you got preferred at the top. Standard is just what it is. It's standard, it's middle, average health, and substandard. Below standard, or even rated. Sometimes you'll see it is called rated, which just means they're substandard and they're not in tremendous health. Premium determination, how the insurance companies get this, premium amount that they just come back with after the application's done and they view all the risk. It's going to be based off mortality, interest, and expense. It's going to be primarily based off of the insurance company's bet of how long this individual will live with the conditions that they have. And then and then mode, which just means the frequency that the premium is going to be paid. So the higher the premium, how often you get it paid. So let's say you pay it annually. If you get a premium that's annually, typically it's going to be a little bit cheaper than, semi-annually or monthly or quarterly. So if you get a client who wants to save a little bit of money on their premium, look at an annual premium, and it actually helps you guys out. Just make sure that they make all their premium payments for the year, so you don't have to worry about reversals or anything, but we'll get into that later. So the different modes that you can do, the different payment frequencies that you can have for a client is going to be monthly, quarterly, semi-annually, and annually. And obviously, it's just like anything. If you pay for anything in bulk, you're going to get a discount. If you pay for it more frequently, even though it's going to be a little bit cheaper, per month, or at least in that initial payment, rather, it's going to be more expensive throughout the year. So make sure you understand that as well. Policy issue and delivery. Effective date of coverage. If the premium is not paid with the application, the agent must obtain the premium and a statement of continued good health at the time the policy is delivered. So a lot of times you'll see that whenever, hey, we submitted the application, maybe they're getting medicals, they're getting labs, and it takes several weeks to months for the insurance company to come back and say, okay, we approved them at this rate. They're going to want you to sign a statement of good health, which just means that you haven't had any health issues since we initially submitted that application. Throughout that time period of waiting before you got approved, that you didn't have a heart attack or a stroke or anything. Nothing happened during that time from the application to the delivery of the policy. And that really, like I said, is you're going to see that if somebody has to go through a series of medical labs, or the insurance company sees something on the MIB report and they want to push off that, that timeline just for them to do more research and more due diligence on their end. So typically, if you can, you want to get the premium at application, because that is really going to help make sure that they have coverage day one. But if the insurance company is taking a while to approve it, then you're going to have to get a statement of good health, and that's whenever the effective date of coverage will begin. Federal regulations, Fair Credit Reporting Act. It's very, very much what it sounds like. It just protects consumers against circulation of inaccurate and obsolete personal financial information. Fair credit, you see the F in fair, just know that they're talking about financial, or if it's credit that helps you. I know a lot of people think of like credit scores or anything like that. So just understand that they want to protect consumers from inaccurate or obsolete personal financial information. You can't be in debt and saying that you have several assets or cash in the bank account or whatever it may be, but they don't want the spreading of false financial information. So Fair Credit Reporting Act, think of credit, think of the F for fair for financial protection and financial information. Graham-Leach-Bliley Act. This prohibits insurers from disclosing non-public personal information to non-affiliated third parties. The way I remember this is third party, three guys. Graham, Leach, Bliley. I don't want three random guys or a third party knowing about my personal information. So that's where this act protects consumers from the insurance companies just giving out your personal information to three random guys or a third party. So that's how I remember that one. Whenever I see Graham-Leach-Bliley Act, I already know, okay, we're talking about third party personal information. Insurers can't do it. USA Patriot Act. Guys, I really hate to say this, and I'm not trying to be political or rude or not politically correct, rather. But when you hear U.S. Patriot Act, they're going to ask a lot about terrorist activities. That's just it. It's going to be in the language of the test. So it helps address social, economic, and global initiatives to fight and prevent terrorist activities. A lot of it is going to be like money laundering stuff, anti-money laundering standards. We've all seen Ozarks. You can't wash money or whatever it may be, and anything that is suspicious is going to be called a SAR report or suspicious activity report. For any transactions of $5,000 or more that is suspicious, they want to raise red flags. They want you to report it. So really understand that. Know the number 5,000. It used to be kind of 10,000, but they're dialing it down now to where it's $5,000. If anything that's above that amount, that's really suspicious. It's very important to understand that. And guys, again, I hate to say that, but USA Patriot Act, just know that they want anti-money laundering standards and prevent terrorists or any kind of suspicious or sketchy type of activities on their end. Guys, that is the chapter 1, completing the application, underwriting, delivering policy recap. So hopefully this really helped bring some different kind of perspectives of how you can remember some of these concepts, and look forward to the chapter 2. We're going to dive into that. Make sure that you read the entire chapter, all the information here on the left side, 1 to 2 times, guys. Thanks for listening. And again, hope this helped you guys in your studying journey.